members and friends in Germany, and a good afternoon to our participants joining from India. Thank you for joining us today for the webinar Goods and Service Tax GST 2.0 Key Takeaways for German Investors, organized under the Make in India Mittelstand program in association with our MIIM partner, Roedl and Partner, and for today, guest partner, Khaitan and Co. I am Mona Desai-Tanche, your MIIM coordinator in Germany, and I will have the pleasure of taking you through today's session. Before we continue, the following functions are available to you in the upper right-hand corner of your screen. You will find the control panel here. Here you can adjust the audio settings and choose, for example, between your headset or the computer audio. A bit further down the dashboard, you will find the question panel. Here we request you to post your questions and we shall happily take them up in the last leg of the webinar during the Q&A. For those joining for the first time, welcome, and allow me to briefly introduce the Make in India Mittelstand program. The MIIM, fondly called as, is an initiative of the Department for Promotion of Industry and Internal Trade and the Embassy of India in Berlin. MIIM provides a platform that integrates a wide range of support services for the German Mittelstand companies. It is part of the Make in India initiative of the government and is a program designed to facilitate investment and foster further innovation. The program offers all possible support like strategy consulting, M&A, operational market entry support, tax and legal support, financial services, and most importantly, facilitation of approvals from central and state government agencies under a single umbrella. In today's webinar, our expert speakers will provide in-depth insight into the GST process under the GST 2.0, focusing on how the changes can streamline operations and enhance your profitability. We shall commence today's webinar with an address by His Excellency Mr. Ajit Gupte, Ambassador of India to Germany. Please allow me to introduce him. Mr. Gupte joined the Indian Foreign Service in 1991 and has since built a distinguished diplomatic career marked by a series of significant assignments. From 2010 to 2014, he served as Deputy Chief of Mission at the Embassy of India in Berlin. He went on to hold the position of Ambassador of India to Denmark from September 2017 to March 2021, and subsequently served as Ambassador of India to the Arab Republic of Egypt. And from March 2021 to October 2024, he held that position. On 13th October 2024, Mr. Gupte assumed charge as the Ambassador of India to Germany. And now, after completing a wonderful and successful series of 1 year, we have the pleasure of hearing from the Ambassador himself. Mr. Gupte, congratulations, and the virtual stage is all yours.
Good morning, everyone. Guten Morgen. It is a pleasure to have the opportunity of interacting with a broad section of companies from Germany and India. And today's topic is the reforms in the GST 2.0, and what are the key takeaways for German investors. Friends, as you would be aware, this year we are celebrating the 25th anniversary of the strategic partnership between India and Germany, which was established in 2000. Both countries have a robust legacy of cooperation based on common values, mutual understanding, and a broadening commercial relationship. I'm happy to convey that last year, our bilateral trade reached a record high of US dollars $50.4 billion. Germany is India's largest trade partner within the EU, and it accounts for about 27% of India's trade with the EU. I would like to emphasize that our trade with Germany is very high value because we export a lot of important items, electronic items, electrical items, specialized steel alloys, aluminium. There is a good interdependency in automobile components. Similarly, from Germany, India imports capital goods, industrial machinery, pharmaceuticals, chemicals, which contribute to India's economy significantly. Now, friends, you would be aware that India introduced a GST system. This was introduced in July 2017. It was able to integrate and also subsume a lot of varied taxes imposed by states into one unified tax structure. It thus eliminated cascading taxes and also ensured a lot of compliance because there was interlinking of the GST claims. It also established a single national market with common rates and procedures. Now, the GST system, the GST tax system has had significant implications in India in formalizing the economy because there were many businesses and companies which were operating in the informal sector before on a cash based economy, but they were, because of the way the reforms were carried out, they became part of the formal economy. This has also enabled the government to raise significantly higher taxes, and GST taxes reached a high of about 2,40,000 crores in a few months. So that is about close to $30 billion of revenue, of tax revenue per month before the reforms. Now, in today's uncertain world, there was a need to stimulate the Indian economy, which is to a large extent driven by the domestic market. As you know, the domestic market is very significant with about 400 million people in the middle class, another maybe 60 to 80 million people in the upper class, and many others joining the middle class. The GST rates, where there were earlier four rates, have now been simplified into a two slab structure of 5% and 18%. In fact, a very large number of items are now in the lower GST rate of 5%. The focus is on fair taxation, reducing the cost to the consumer and thus enhancing purchasing power. The main objective is to stimulate consumption by making goods and services cheaper. Many services have also been, like insurance, do not now have any GST. German companies and investors stand to benefit significantly from India's recent GST reforms. The GST reforms have already led to an upsurge in consumer spending, and it is likely to further unleash growing demand across a wide range of industries and sectors. Friends, we are also simultaneously trying to digitize the GST processes, ensure that filing can be done online, that there are faster refunds, and there is easier registration for new companies. Those of you who are operating in India for the last few years would agree with me that the GST reforms have indeed had a significant impact on formalization of the economy. In the automobiles and auto component sector, which is of interest to Germany, there is now a clearer classification of vehicles and auto components to reduce disputes and compliance burdens. The GST rates for small cars, two-wheelers, three-wheelers, buses, and commercial goods, that is trucks and vans, have all been reduced significantly from 28% to 18%. In many cases, this means that vehicles are now $1,000 or even $2,000 cheaper for the Indian consumer. As you know, Diwali is now around the corner, and it is a time when a lot of Indians purchase new goods, and we are already seeing expansion in consumer spending. So, for all vehicles, the GST rate has come down from 28 to 18%, and the GST rate for auto components and auto parts has similarly been reduced from 28% to 18%. These reforms would spur consumer demand for automobiles and also increase their export competitiveness. German auto companies and auto component manufacturers, as well as logistic companies, stand to gain from an invigorated market. There is increased scope and incentive for investments, trade, and to strengthen supply chain linkages. Friends, another sector is the textile sector, where the GST rates on man-made fiber have been reduced from 18% to 5%, while the rates on man-made yarn, I'll repeat, man-made yarn, have been reduced from 12% to 5%. This rationalization corrects the previously inverted duty structure and will also spur consumer demand as well as potential for trade, supply chain integration, and investments by German companies in India's textile sector. In the area of renewable energy, where India is already the fourth largest producer of renewable energy in the world, and we just crossed Germany, the GST rates have been reduced from 12% to 5% for renewable energy devices, including solar and PV cells, wind energy, biogas, waste to energy, and tidal energy. The renewable energy sector is one of the most important components of bilateral trade and investments, and this would increase the affordability of renewable energy for India's population. I hope more German companies will consider entering the renewable energy space in India. Friends, the GST too has undertaken a comprehensive reform of rates for pharmaceuticals, drugs, medical devices, and instruments, and these now attract a concessional rate of 5%. Moreover, there is a nil GST rate on life-saving drugs and diagnostic kits. The concessional 5% rate would be applicable to non-exempt medical, surgical, dental, and veterinary devices, including spectacles, lenses, and corrective goggles. Again, these reforms would increase the affordability and accessibility of our people to high-quality medical care, thus providing opportunities for joint innovation, co-development, manufacturing, and trade for German companies in the areas of pharmaceuticals, medical devices, instruments, and optical aids. I specifically mentioned this sector because India is a significant importer of medical devices and instruments, as well as some specialized drugs from Germany. Friends, there is increasing cooperation in drones uh, between India and Germany. There is a lot more potential which can be utilized. The GST rate for drones was earlier at 28%, while for drones with integrated cameras was 18%. We have now brought down the rate to a uniform 5% for all types of drones. Drones are increasingly being used in India in various sectors such as agriculture, mining, the power sector, for development of infrastructure, logistics, and of course for surveillance. I do hope this will encourage more cooperation between startups and companies in the drone sector with their counterparts in India. In the area of agricultural machinery and equipment, where there are some German players, in India, the GST rate has been again significantly brought down from 12% to 5%. The GST rate on tractors of 1800 cc has been reduced from 12% to 5%, and for tractor tires and parts has again been reduced from 18 to 5%. The GST rate on toys and sports goods has been reduced from 12 to 5%. This provides an opportunity for German companies to source more sports goods and toys from India and form an internationally integrated supply chain which is dependable and diversified. Similarly, the GST rate on prepared and preserved vegetables, fruits, and nuts has been reduced from 12% to 5%. This would encourage investments in food processing, value addition, and cold storage chains while ensuring that farmers receive better prices. This is again an area where German companies have interest, and there are many opportunities which remain untapped. Friends, let me conclude now by saying that the significant reforms carried out in GST2 provide many opportunities for not only accessing the Indian market but also for using India as a manufacturing hub for exports to other countries. I do hope that German Mittelstand will explore opportunities in India. India's overall emphasis on enhancing ease of doing business and offering incentives to foreign companies has now been supplemented by a significant reduction in taxation through the new GST reforms. I do hope that in today's uncertain world, the German companies will look at India afresh, and I hope that today's webinar will increase awareness of the Indian market as well as recent reforms in India. Thank you very much for once again for inviting me and giving me the opportunity of interacting with you.
Thank you very much, Mr. Ambassador. Thank you once again for being present with us here and for throwing light on India's growing significance in the global as well as German economy by elucidating various industry sectors to the GST regime. Something that our guest speaker for today, Mr. Sagar Shah, truly recognizes and values. Mr. Shah is currently the Director Compliance at the Indo-German Chamber of Commerce in Mumbai, a thrifty chartered accountant with over a decade of experience in tax advisory and litigation. He has worked in the past with Ernst & Young and advised international clients. At IGCC, he leads compliance, governance, and risk management initiatives across India. His diligence and financial acumen are truly commendable, ensuring transparency and navigating the complexities of finance, thus highlighting his role and, if I may say, as a doctor of economic health of the firm. We extend a warm welcome to you, Mr. Shah, and are honored to have you join us today. Sagar, the floor is all yours.
Monas, thank you for the fantastic introduction. So, to begin with, a very good morning to our guest in Germany and a very good afternoon to our guest in India. It's so wonderful to see so many of you joining us today from different locations. A big thanks to the embassy for organizing this important conversation to discuss something that could significantly change how the businesses operate in India, the recent reforms in India's goods and service tax regime. As the chamber, one of our core responsibilities is to facilitate meaningful dialogue on policy changes that impact our business community. These GST reforms represent a significant shift, and it's important that we come together to share perspectives and understand the practical implications. We genuinely appreciate the Indian government's efforts in simplifying the tax structure. It's a step that demonstrates responsiveness to the industry concerns. Platforms like today's webinar are essential in helping our members to navigate these changes with clarity and confidence. I would Like to acknowledge our two distinguished speakers today, Mr. Sudipto Bhattacharya ji from Khaitan and Co. and Ms. Khushbu Jain from Roedl, India, both specializing in indirect tax. Both bring tremendous expertise to today's discussion, and I look forward to their insights. Turning to the heart of today's topic, the Indian government has taken what we consider a bold and a decisive step to streamline and shorten GST structure in ways that reduce complexities and create real opportunities for businesses, particularly for companies with a long-term vision, like many of our German partners. Many a times in the chamber, there's a quote that I often reflect on from Goethe: "Knowing is not enough; we must apply. Willing is not enough; we must do." And that's exactly what we are seeing now. The policy being put in action, and action that favors growth, investment, and competitiveness. India has rationalized its GST structure from four rate slabs down to essentially two primary rates: 5% for the essential goods, 18% for most other goods and services. A higher bracket of 40% now applies to luxury and what we call as sin goods. But beyond the rates themselves, there are crucial procedural improvements, easier access to input tax credits, faster refund processing, and simpler and simplified compliance norms. It it is not a mere technical tweak, but a strategic signal from India to the global business community. And let me just share why this matters, especially for the German companies operating or evaluating India. First, sectors like electronics, automotive components, and consumer durables have seen rate reductions from 28% to down to all the way to 18%. That's a direct impact on the cost structure, better margins, more competitive pricing, and stronger market positioning. Secondly, with the essentials tax at just 5%, domestic consumption is getting already a big boost. We have already seen evidence of this. During the recent review, the retail sector, including the automobile sector in India, has surged from 25% to 100%. That's consumer demand, responding in real time to these reforms. Thirdly, and this is critical, for all the finance team across all companies, the working capital pressure, it's easing. Fewer classification disputes mean your cash isn't stuck anymore in the system. You can reinvest more efficiently into your operations. And finally, the regulatory certainty has improved. A simpler GST structure means fewer gray areas, fewer disputes, and a more predictable environment for long-term planning and investment. German companies, which are specially known for their precision, engineering excellence, and a long term outlook, whether you are in automotive, chemicals, machinery, or consumer goods, this reform opens a space for you to recalibrate strategically, to expand manufacturing footprints, align pricing models more competitively, and participate more deeply in India's growth story. Of course, no reform is without nuance. Some luxury segments will see higher taxation, and yes, the transition will require careful compliance planning. Our speakers today will help you to navigate those details, but make no mistake, overall, this is an enabler, not a barrier. The the opportunity now is to act, to revisit your product portfolios, rethink your supply chains, reposition for both the Indian domestic market and a broader export strategy. The Indo-German partnership has always been built on innovation, trust, and resilience. This GST reform gives us fresh platform to take that partnership even further toward the shared growth and mutual prosperity. Before I hand over to Ms. Desai, I thank you all for joining us today, and we look forward to an engaging discussion. Ms. Desai, over to
Thank
you.
you, thank you, thank you, thank you, Sagar. Thank you very much for addressing us and also sharing valuable tips on how to keep businesses running strong and successful in India. So thank you. Additionally, I also want to thank you. We also want to thank you and IGCC for partnering with us in today's webinar. We are truly grateful and hope to continue to benefit from your much valued presence going forward. So thank you once again, Sagar. Moving on, our first expert speaker for today, she is going to guide us through the crucial balance between numbers and responsibility. It is my pleasure and privilege to introduce you all to Ms. Khushbu Jain, Principal Associate Indirect Tax at Roedl & Partner. A chartered accountant and qualified lawyer, Khushbu brings over 30 years of expertise in indirect tax. Before joining Roedl & Partner, she has worked with Deloitte and Ernst & Young. Khushbu's advisory work spans a range of complex tax issues, including transaction structuring anti-profiteering, GST and customs clarifications, discounts, intermediary services, and inverted duty structures. She has successfully managed GST and custom matters for a variety of industries, including FMCGs, services, and manufacturing. Khushbu, we are very happy to have you here today with us. Thank you.
Thank you, Monaz, for my introduction. Good morning, everyone. I'm Khushbu Jain, and I'll be taking you all through the major rationalization and policy reforms. And the agenda of our presentation for today would be what is the next horizon for intermediary services, post-sale discounts, and refunds going forward. So, firstly, the most interesting part of this GST 2.0 was the change in the intermediary provisions of the intermediary services. With a lot of companies which we handle in Germany, Europe, and everywhere, there is a common issue of intermediary services being taxed. And this levy was introduced in the service tax regime, like in 2014, and then it kept on attracting a lot of litigation under both service tax and GST regime, that whether what will qualify as an intermediary, who all will be required to pay tax, and eventually the companies were taxed for the intermediary services like marketing services, sourcing services in India for their customers located outside India. Now with GST 2.0, the council has recommended that the place of supply of these services would be outside India. That means that now the intermediary services will qualify as exports, bringing a lot of relief for the clients which are looking forward to find business in India by appointing an agent. So, a small example, like what is the present taxability of intermediary in India and what will be the future taxability. If you see on your left, the present taxability attracts levy of GST on supply of services by an intermediary who helps in marketing or customer solicitation or procurement and sourcing of goods from India to foreign countries. However, going forward, these all services will qualify as exports. Please be informed that though the change in the GST rates have been made applicable from 22nd of September, but this change in the provision of intermediary will come through next finance bill, which will be for FY financial year 26-27. Importantly, what we like to highlight is that with this change, you can go ahead with business can adopt an agency model, but then company has to see the permanent establishment impact under income tax as well. So though it has been like zero rated under GST Act, the intermediary services, but from the income tax point of view, this has to be looked upon, the agency model. Next, the major change which has come in is the post-sale discounts, how they will be now treated under the GST laws. So when GST law was introduced in 2017, the post-sale discounts like turnover discounts or after-sales discounts were to be followed in a certain pattern. Like post-sale discounts used to be flow through an pre-agreed agreement between the parties that yes, if you, for example, if two companies are working together and they want to give a post-sale discount on a certain turnover, that has to be agreed much before the sales could happen. Then these post-sale discounts were supposed to be linked to the original invoice through which basis which this post-sale discount has been given. And this post-sale discount used to flow through credit notes. Now with the amendment which has been proposed by the GST Council, the conditions of pre-agreement between the parties and the linkage of original invoice has done away with. Now you don't need to pre-agree the post-sale discounts which will be given after the sale, and you don't need to show for against which invoice these discounts pertains. However, the passing on the discounts will happen through credit notes. So this reduces a lot of compliance for the taxpayer. Plus, these post-sale discounts used to be happen through financial credit notes or commercial credit notes. So there is a reduction in compliance burden on the financial credit notes. Further, the government has issued a circular clarifying how these changes has to be taken care with, wherein the government has clarified on the points, especially on no ITC reversal required for financial and commercial credit notes, treatment of manufacturer discount to dealer as additional consideration like turnover discount, uh, dealer discount, etc. Treatment of discounts as consideration for promotional activities like advertisement marketing by the dealers done for the manufacturers. This circular has been issued on 12th of September 2025. Next major change and a relief which has come from the government is the refunds on with respect to zero rated supplies, that is exports, and sales made under inverted duty structure. As you are aware that what is inverted duty structure, wherein your input sides are taxed at a higher rate, whereas your outward supply is taxed at a lower rate, creating a chunk of ITC in your GST portal. Now, the government has come up with this suggestion that 90% of the refunds shall be provisionally sanctioned against zero rated supply inverted duty structure, of course, on subject to conditions which are required to be met for export of supply and inverted duty structure. There will be a detailed scrutiny before provisional refund in case of some exceptional cases. The government portal will decide low risk taxpayers who will be given 90% of refund provisionally. There will be a special list which will be issued by the government sanctioning those taxpayers who will not be allowed to have a provisional refund. This 90% of sanction provisional is applicable for both zero rated and inverted duty structure, and this will be applicable for the refund applications filed on and after 1st of October 2025. However, these provisions are applicable from 1st November 2025 onwards. Like my previous speakers have already touched upon, that the GST rates change have been done from 5 tier to 3 tier now, merit being 5%, standard rate at 18%, and demerit rate at 40%. This will bring a positive impact on supply chain and efficiencies. This will attract higher investment in trading and manufacturing in India. Further, these rates will give a proper demand and affordability to consumer base so that they can afford the goods going forward, and this will improve overall competitiveness and encourage product diversifications for MSMEs and SMEs. So this is a welcome change from bringing a technical classification to a bit standard classification. We have touched upon a few goods which have attracted a rate change, though there are a lot of goods which have gone through a rate change, but few to touch upon, like healthcare services, healthcare products which required a lesser rate, which was earlier taxed at 18 or 12%, which are now being exempted or taxed at a lower rate. Everyday essentials, bringing consumer for normal citizens to bringing it to exempt and 5%. Automotive industry from 28 to 18%, bringing in price of the cars at a lower rate. White goods, air conditioner, refrigerator used to be taxed at 28%. Now a normal income group can also reach out to such goods and they can buy that. Construction services have been made to pay lesser tax as compared to 28%, which is a good initiation for people who can look forward to buy houses. Transportation services has seen a major change by bringing goods transport agency under 18% bracket with ITC, whereas earlier it was 12% with ITC. Rest taxation remains the same. Similar to vehicle rental services, 5 and 12% has been changed to 5 and 18%, keeping the taxation policy same. So the major impact of GST rate change, what can be seen is It is for streamlining the rate structure and resolving the classification disputes, which have become the major litigation issues in the courts. With this, I close my presentation and over to you, Sidipto, for the litigation part.
Hi, Khushbu. Thank you very much for that insightful navigation through the maze of the different rates. And also thank you for those critical notes on how to stay on the right side of the law, if I may say, of local laws. Moving on, we have for today our next guest speaker, Mr. Sudipto Bhattacharjee, partner, indirect taxes and customs at Khaitan and Company. Please allow me to introduce him. It's my pleasure today to do so. Sudipto is a lawyer with more than 20 years of experience specializing in advisory, investigations, litigations across all levels, contractual disputes, and allied aspects of contract documentation. Includes customs, international trade laws, indirect taxes, state excise laws affecting alcoholic beverages and sectors, as well as building and labor sectors. He advises clients across sectors spanning from manufacturing, oil and gas, mining, healthcare, alcoholic beverages, real estate, to sectors such as online gaming, crypto, NFTs, and e-commerce. Sudipto has been recognized as a highly regarded expert in indirect tax by World Tax, the comprehensive guide to the world's leading tax firms, since 2020, and has been recognized multiple times for indirect tax for India by the International Tax Review since 2017. He has been ranked for tax in Chambers and Partners as well as Legal 500. Benchmark Litigation Asia Pacific rankings have recognized Sudipto as a litigation star for tax from India 2024 and 2025. He is the author of a highly appreciated treatise on how GST applies vis-a-vis various types of EPC and construction contracts. With all this under his belt, he can very much justifiably be called a sentinel of financial health and stability. Ladies and gentlemen, I present Mr. Sudipto Bhattacharjee.
Thank you, Monaz, and a very good morning and a very good afternoon to all of you. Hope I'm audible and my slides are visible to all of you.
Yes, Sudipto.
So very quickly, the biggest aspect about GST 2.0 is the rate reform. I think all the speakers before me has touched upon it. I'll not go sector by sector, but what is the aim, what is the objective behind these rate reductions across multiple sectors? As His Excellency the Ambassador pointed out, the idea is to stimulate domestic consumption. How will domestic consumption get stimulated by GST rate reduction? Only when the benefit of this rate reduction gets passed down by way of price reduction for the end customer. And this is where I think the issue arises, or there's some bit of nuance that comes in. Because it's not a linear math, right? If your price or if the rate on the output side has gone down from 18% to 5%, but your input side rates remain at 18%, or it has gone up, or there are other commercial factors that has pushed up prices on your input side, are you still required to reduce your price by 13%? The question that arises is obviously, given the stress that the government is laying on reducing price on the output side to make more money available in the hands of the proverbial Aam Aadmi, the common man and woman in India, what is the legal obligation in this regard? So let's quickly look at the sources of law which may be relevant in this case. First and foremost is, of course, Section 171 of the CGST Act, which is better known as the anti-profiteering provision. This was there when GST came in the year 2017. A lot of litigation, lot of complaints were filed under this, and several companies ended up paying a fair amount of fines, etc. Constitutional validity of this has been challenged. Delhi High Court has upheld the same. However, this is now currently the constitutional validity issue is pending before the Supreme Court. Be that as it may, the section continues to be there in the law. However, what has happened is a few months back, the government issued a sunset notification. What basically means what basically emerges from the sunset notification is today no one can file a complaint under section 171. But has it become a dead letter of law? It is not, because the GST appellate tribunal can take suo motu cognizance, which means it can on its own take cognizance of any egregious cases of violation, any brazen cases of violation of profiteering provisions. However, as such, risk of proceedings or risk of proceedings at a scale under 171 can be, practically taken to be fairly low. Which brings me to the second source of law, which is section 64A of the Sale of Goods Act. What that section deals with is a scenario where there is an output rate reduction on a particular item. Say cement rate has gone down from 28 to 18%, and there is a contract in which you had entered into a contract for 100 rupees for a specified quantity of cement plus 28 rupees. Automatically, the contract price should come down from 128 to 118, unless there is a different agreement emerging from the contract itself. 64A is of limited applicability. It says that in a linear direct transaction, if the rate of tax has gone down, the sale price should also commensurately go down, and vice versa. So section 64A will apply in a limited set of circumstances. When there is a direct rate reduction, it would apply, and unless there is a contract to the contrary. But 64A does not deal with scenarios where there is a change in price, change in rate on your input side, where there is additional benefits emerging from your input side rate changes or commercial changes. For that, one may need to look at Consumer Protection Act. And Consumer Protection Act has also been mentioned a few times by the government in the context of the GST 2.0 rate reductions. Consumer Protection Act, the relevant phrase that we need to remember, the relevant trigger is unfair trade practice. Because bear in mind, consumer protection is a broad-based act to protect the interest of the consumer. It does not deal specifically with rate changes, GST, pricing, etc. What it tries to do is to protect consumers from unfair trade practices. And if you look at the definition of unfair trade practices, the words that keep getting emphasized is misrepresentation, misleading the consumer at a large scale to enhance the sale of your products, etc. So in a scenario where I cannot reduce my output price because there are commercial factors on my input side, because there are input rate enhancements, or because there is excess credit now sitting on my input side. I mean, in the cement example that I gave, if 28 was the rate yesterday and suddenly it has become 18, I am sitting on a lot of accumulated credit. And while it's an asset today, 2 years down the line, my auditors may ask me to reverse that credit, may ask me to write that off, which will then make it an expense, which will then cause a loss to me. Do I get to factor in price in this commercial aspect when I'm thinking of reducing my price from a GST perspective, from a GST 2.2 perspective? I think these are questions that do not have very clear answers from the Consumer Protection Act. In my view, if we look at the definition, the threshold to meet the test of unfair trade practice is rather high. And if for genuine commercial reasons, for credit accumulation reasons, we cannot pass on, I don't think the threshold of Consumer Protection Act will be met. And if we look at the government stance in terms of enforcement, yes, the government, what it is trying to do, it is very keen to ensure that the industry does pass it on. But the approach it is taking is, we will call it nudge, not force. It is gently nudging the industry that take reasonable efforts to pass on the benefit. We are foregoing a lot of revenue, so we want the benefit of that to trickle down to the end consumer, because that is the way to unlock consumption. At this point, while they are keeping a very close watch on the market, from a legal enforcement perspective, all they have said is that you can raise complaints in the consumer protection portal. I'm told that about 3,500 complaints have already been filed, but whether or not they meet the test of unfair trade practice remains to be seen. I think the bulk of the enforcement effort by the government will focus on nudging, will focus on reporting, rather than hardcore, strong legal action. We may see one or two instances of that, but I don't think it will be a widespread industry-wide litigation as we saw in the specific context of anti-profiteering. Couple of additional things that need to be kept in mind for businesses if we are not able to pass on by pass on the benefit of GST 2.0 because by way of price reduction, we need to have a clear justification. We need to have very robust costing and pricing data. We need to have vendor communications to buttress the fact that nothing has been passed on by my vendors on the input side, so I cannot really pass on benefits. If we are choosing not to pass on benefits by reducing price at all, or if we are not reducing price commensurate to the actual rate reduction on the output side, that needs to be backed up with a lot of commercial rationale, which will stand up in a court of law, which will stand up to scrutiny. Informal statements made by senior tax officers, I mean, it has been reported in the media widely. There is a lot more flexibility today under GST 2.0 to pass on the benefit. It doesn't necessarily need to be only by way of reducing price, increase in grammage, increase in quantity. That has also, while there is no formal clarification, I think there has been enough, media statements, enough conversations at public platforms like ASOCHAM, FICCI, etc., where I think where officers have hinted, where senior bureaucrats have hinted that passing on by way of increasing grammage instead of reducing price at a SKU level would be acceptable, because this round of price reduction is not governed strictly by 171, the anti-profiteering provision. It is more flowing from the intent of the law, intent of the reform, and equitable considerations. Moving on quickly, talking about price reduction, the next thing that comes up is how do we reduce the price? Do we need to relabel the MRP stickers? Standard practice under Legal Metrology Act, read with the packaged commodity rule, is yes, you will need to individually for each SKU put fresh MRP stickers, etc., and that could also only be done by manufacturers, etc. So it would have led to a compliance nightmare. In fact, in the initial days when clarifications were not issued, a lot of manufacturers went through a lot of trouble to sort of manually do the re-stickering without obscuring the original MRP. Thankfully, and the reason why they would have done it is because of there are penalty exposures under Legal Metrology Act. Potentially for repeat offenders, there could even be a prosecution risk. So to avoid all of that, companies were undertaking the painstaking compliance step of re-stickering. Thankfully, on 18th September, Ministry of Consumer Affairs have clarified that a number of relaxations have been granted. So instead of re-stickering, revised price circulars, communication, in terms of relaxations have also been granted in terms of usage of old unused packing material. So I think these will reduce legal risk and litigation risk significantly for companies, especially in the FMCG space, especially in the consumer-facing space. Khushbu touched upon the expedited refund bit when it comes to inverted duty structure. I think I'll flag one specific point here, that if you look at the law, if you look at the section under GST law which grants that right of refund, that has not yet been amended specifically to allow provisional refund for inverted duty structure. That continues. Provisional refund under the law is still available only for exports. However, the instruction number 6, as is mentioned in the first bullet of my slide, that specifically allows or extends this benefit of expedited refund not only to zero rated supplies, which is basically the export supplies, but also to inverted duties cases, inverted duty scenarios. So in a scenario where you have filed the inverted duty refund, but there is a delay, there is no movement in the refund application, we can rely upon this instruction to seek judicial review by way of filing a writ petition or by raising a grievance redressal complaint to a senior GST officer in that jurisdiction by relying upon this particular instruction. So to that extent, this instruction could be a good legal tool to expedite refund if in the normal course it is not happening. Quickly, I'll touch upon 2 or 3 transitional issues that has arisen because of these GST rate changes. I mean, we have already spoken about inverted tax structure, but if we sort of reiterate that example of cement, where if you are a wholesaler, you are sitting on a large inventory of cement which you have purchased at 28%, and suddenly on the output on 22nd September, the rate has now become 18%. You are effectively facing an inverted duty structure because of a rate change on the same product. Are you eligible for an inverted duty refund? If we look at the legal provision, there is no exception or carve out for a same product. It grants, the provision grants inverted duty refund in every case when the rate of tax on input side goods is higher than the rate of tax on the output side supply. However, there was a circular that came in 2020 where refund of inverted duty structure on same goods taxed at same different rates at different times, which is basically the cement example that I just gave, that was specifically restricted. Now, of course, the circular was without basis in law. The circular was going beyond the legal provision, and 3 high courts, Guwahati, Rajasthan, and Calcutta, struck down this particular circular as being ultra vires the law, as having gone beyond the law. So, if in any specific case in the coming months, if your inverted duty refund is getting rejected by quoting this particular circular, and the reason why I flagged this aspect is because the FAQs that were issued pursuant to GST 2.0 does mention this particular circular of 2020, then two conclusions or 2 nuances may emerge. One, of course, such a rejection can be challenged by way of a writ by relying on this Guwahati, Rajasthan, and Calcutta High Courts, because these have not been appealed to the best of my knowledge before the Supreme Court. And second, you can use the FAQ and the circular to justify not reducing your output price. You can say that, look here, because of this circular read with this FAQ, my inverted duty, I'm facing an inverted duty structure. There is an accumulation of credit which I may eventually need to write off. So there is clearly no benefit ultimately on a net basis to be passed on, and this could be a reasonable defense. So these 2 legal nuances that emerge from this particular circular and the recent rate changes ought to be kept in mind. The next point, somewhat connected, is in the context of requirement for reversal of input GST credit. So if something has become nil rated, something which was at 5% or 18% but has now become nil post the GST 2.0 rate changes from 22nd September. As a supplier, as a registered taxpayer, do I need to reverse the input credit vis-a-vis that particular product? And the source of law here is section 18(4) of the CGST Act, which gets triggered when a particular product or service becomes wholly exempt, when the goods are in stock, when the goods are in your inventory. So when these goods become wholly exempt, there is a reversal of input credit requirement that gets triggered. But is GST 2.0 one such scenario? Here, I think 2 or 3 legal points that need to be kept in mind. Firstly, what has happened is GST rate changes have happened by way of a rate notification, not an exemption notification. So even when something that was at 5% or 18% or before 22nd September, but has now become nil, there are strong legal arguments to say it has not become wholly exempt, because it is merely a rate change. It is not an exemption notification. The same issue would also arise in the context of compensation cess, and this is particularly relevant in the automobile space, which is of particular importance to this particular this segment. In the automotive space, there's a massive amount of compensation cess that is sitting in the existing inventory, and of course that has now become nil. From 22nd September, it has become nil because compensation cess, except for tobacco products, has effectively been done away with. The same question arises: is there a requirement to now reverse compensation cess that is lying in our credit ledger? And my answer is that there are strong legal arguments to say the answer is no. There is no requirement to reverse, because this is not a scenario where it has become exempt. The compensation cess rate change, where it has become nil in the context of automobile, is also by way of a charging section, section 8(2) of the Compensation Cess Act, and not by way of an exemption. And the definition of exempt supply, if you look at the GST Act, it does include a case where something is nil rated. But this definition, it is possible to argue, does not get attracted in the present facts in the context of GST 2.0 rate reduction, because the word used in section 18(4) is become wholly exempt and not exempt supply. So it's not the same phrase, it's not the same definition, and to that extent, I think there is a good legal case to say there is no requirement to reverse. The reason I'm flagging this is, in many jurisdictions, state GST authorities have already started reaching out to companies, especially in the automobile space, or even people who were in the coal business, where there was a significant accumulation of compensation cess. The state authorities are asking, have you reversed credit? Have you reversed credit? I think there is strong legal argument to push back against any such demand. It may be litigative, but this is, we are on very strong footing on this particular transitional issue. Moving on very quickly, closing balance of compensation cess, again connected issue. If I'm sitting on a massive closing balance of compensation cess, can I get a refund of this? Can I use it for as a credit against my future payment of GST? Because now there is no more output compensation cess. The CBIC chairman has very clearly clarified, no, there will be no such refund or adjustment, which basically means that this amount will lapse, or this will become a cost, this will become an expense item. This, of course, will get challenged in writ petitions. Judicial review will be sought, but we need to remember that the success rate for similar cases earlier, also in the context of education cess, Krishi Kalyan cess, Swachh Bharat cess, etc., similar petitions were filed. High courts were not in favor of the taxpayer. Of course, the matter is now in the Supreme Court. Is this a battle worth fighting? If you have a large amount of accumulated compensations as credits, certainly there is no downside to it. There is a good legal argument to say that you cannot take away my vested right, but it will not be a slam dunk. It will not be a easy win. It will have to be argued fairly fraud. But like I say, there is no downside. So this may be a good judicial strategy to ensure you save some amount of the compensation cess, which otherwise will just have to be expensed out. I think intermediary Khushbu has already captured very at length. The only thing I'll highlight is that this will be a huge positive for the GCC, the global capability centers that are all the rage in India. Everyone is setting up GCCs in India, and this was a cloud that could have arisen on GCCs because questions were being raised as to whether GCCs are providing export of services or do they qualify as intermediary. In 2026, when the amendment comes into play, I think this will become complete non-issue, and this uncertainty over GCCs is gone, which is a massive positive for GCCs in India. This amendment is expected to be prospective, so we don't foresee a impact on pending intermediary disputes. In terms of a new impact area, if there is an Indian entity which is appointed an agent, which is appointed a marketeer in a foreign jurisdiction in EU or somewhere else, there could be a fresh liability, because now that foreign entity could qualify as someone who is providing services to the India entity, and the India entity may become an importer of service. Till now, on the basis of the intermediary exception, one could say that place of supply was outside India for such a marketeer, for such an agent, and no GST would apply. But that scenario will flip now once this amendment comes in. However, on balance, this is a great amendment. This was causing a lot of litigation, which will now be done away with. Post-sale discounts, I think, has already been touched upon and dealt with at length by Khushbu. I'll skip this, and I think that brings me to the end of my slides. Thank you, and happy to take questions. Monaz, over to you.
Thank you very much, Sudipto, for sharing insightful statistics, parameters, and a plethora of opportunities together with the positiveness that GST 2.0 has to offer. So let's dive straight into the very first question that we have got. Sudipto, this is for you. How does the GST 2.0 changes specifically affect commercial real estate transactions with regard to leasing and property development in India?
I think, see, GST 2.0, if you look at it, the specific change that has happened is the reduction in rate of cement, and there are a few other construction materials where the rate has gone down. In the context of commercial real estate, there is no credit blockage. To my mind, there should be a reduction. I mean, the benefit of this the benefit of this reduction in rate should get passed on, and there should be some amount of reduction in terms of the ultimate leasehold, lease rent, etc., that is being paid. Secondly, while GST not directly connected with GST 2.0, around the same time, amendments in GST law were brought in the context of credit, which was to overcome and deal with the earlier Supreme Court judgment in the case of safari retreats. So this retrospective amendment, which has come in the context of credit, could impact a large part of the construction sector, but specifically in commercial leasing, I would think, and this is a battle that we are fighting in a couple of high courts. I would think there are enough legal arguments to say that the retrospective amendment in the context of input credit that has come in from October 1 does not impact commercial leasing, because when I am creating an asset which is to be used for our output taxable activity, we are still protected by the Supreme Court judgment in Safari Retreats, and the October 1 retrospective amendment does not cover this particular segment. It covers a factory scenario, it could cover a residential real estate scenario, but it does not cover a commercial leasing scenario. So to my mind, I think these are the twin impacts I could think of.
Thank you. Thank you very much, Sudipta, for really giving a concise and a comprehensive response to that. Second question we have is, we have an assembly of our wind turbines in Germany and India. What is the optimal way to make import from India to EU when needed?
So see, I mean, that, to be honest, is beyond the scope of this particular session. This is more on the customs and trade front. Optimal way, I would say that if we can wait, I think I'm very hopeful that the India-EU free trade agreement should get signed in the next 6-7 months. If we can wait that long, I think the import process will get eased out significantly. Currently, of course, it will be subject to the typical import clearance processes in EU, in Germany. India, we need to remember, has now a bit of an oversupply when it comes to renewable energy products. So there could be a lot of push to export to Germany and to other destinations. But I mean, beyond that, I think in terms of the specifics, we can address that separately.
Thank you very much. I think a lot of us and all whoever's there today are very hopeful for that trade agreement to take place and see light of day. We have one more question. I leave this open. Are these revisions applicable only to European countries or across the board to any part of the world?
These are general sort of amendments which are applicable to everyone. But of course, given the predominance of where German industry is focusing on in India, the German investment is focusing on India, whether it is automotive, whether it is heavy machinery, etc. The positive or the favorable impact is probably higher in the German corridor for these segments as opposed to some of the other entities. Especially, I think automotive is something where we are seeing a massive traction for German companies already. While if you look at the surveys in the FMCG space, in the pharma space, there are still murmurs of discontent that we can't pass on by way of reducing the price. But on the automotive space, the large German companies have already passed on. There are large newspaper advertisements where they have said, and I'm told the sales have gone up fairly significantly for automotive companies from Germany. Yeah.
Yes, Khushbu, do you want to say something?
Add something on this.
I saw you nodding your head quite fervently.
Yeah, so just a quick thing to add on this, that a lot of manufacturers, European everywhere, that have taken a lot of state subsidies and are working on the state subsidies. And this GST rates changes will have an impact on the state subsidy. So companies are required to relook into the subsidy calculations and compute their benefits again because of this rate rationalization. That's what I wanted to add on this.
Yeah.
Thank you. Thank you very much, everyone. I wish I had more time to take up more questions, but I have some exciting announcement to make actually to everyone here. Mr. Piyush Goyal, Honorable Minister of Commerce and Industry, Government of India, will be visiting Germany next week. And exclusive roundtable with selected German Mittelstand companies is being organized. So all those who are interested, please write to me and I shall get back with you for more information. The proposed date as of now is next Thursday, 23rd October. So this is a wonderful opportunity for the German Mittelstand companies. If you're joining from India, please nominate a colleague from Germany. It's going to be held in Berlin. And Mr. Goyal is looking forward to interacting with you. and we are very excited for this. And with that, it brings an end to this session. But before that, wishing you all a very bright Diwali filled with success and happiness, and may it bring light, joy, and growth to our continued collaboration. So thank you, dear speakers, for joining us today for this webinar with the plethora of information that you gave, and dear attendees, for your constant support and patient listening. I look forward to connecting with you soon. And finally, our
Thank you,
brilliant backend
Manas.
support team, Larissa and Jesse, for their continued support. So till next time, and auf Wiedersehen.
Thank
Thank
you,
you.
everyone, and happy Diwali.
Yes,
Happy
yes.
Diwali. Thank you. Bye.
Goodbye.
Thank you, Sagar. Thank you, Kushbu. Thank you, Sudipto.